Okay, so I'm about to touch on the investment appraisal. That's NPV calculations. This is a simple one. So in my next videos, I'll be touching on inflation and the tax allowable depreciation. So do not forget to subscribe to my channel and like and comment so that I see your problems. So we have a question from the Kaplan, which is question number 274, Warding Cool. So I've already set up the format because of time. So this is a normal format that is a must know. Just a normal format and some addition and subtraction. So the question says that Wadinku plans to buy a new machine. The cost of the machine payable immediately is $800,000. That's the initial outflow. The cost is payable immediately, which is 800,000 cash leaving the business. So it becomes a year zero figure, not a year one. So because you are going to use the machine to generate revenue in the coming years. So the year that we bought the machine is a year zero because we didn't generate any revenue, we didn't do anything with it. So it will become a negative figure under the initial outlay and the year zero. So the year zero is specifically for the initial outlay and the working capital. That's for the year zero. Nothing goes to the year zero except the initial outlay or the initial investment and the working capital. So here the year zero is a negative 800,000. Negative 800,000. So with the negative 800,000, I'll keep the numbers in zeros. So I will put three zeros up. It is acceptable in the exam. So the same thing, three zeros, just three zeros upwards. So it will become a negative 800. That's all. So and the machine has an expected life of 5 years. That is why our years, so our year will start from year zero and end at year six because we don't know the information, all the information in the question. Some information may require us to insert figures in year six, which is a year after the year end of the machine. So you have to always add an additional year to your years. So 5 years, and so additional year will become 6 years. So it has an expected life of 5 years. Additional investment in working capital of 90,000 will be also required at the first year of operation. Will not be food. The fact that it says that 90,000 will be required at the start of the first year of operation doesn't mean that it will be a year one figure. No, it has to be a year zero. Remember, I said it earlier that working capital is also a year zero figure, but this working capital will be recovered at the end of the product life. So the working capital, which is year zero figure, which is 90,000, also a negative figure, to 90, but to be recovered at the end of the year, which is 5 years. So this 90,000 will now become a positive figure, which is 90. That's all. That's 90,000. So we continue with the question, and the question said that the machine will now be sold for scrap with the scrap value expected to be 5% of the initial purchase cost. The machine will be sold for a scrap, meaning that you are receiving cash. It will be sold for a scrap, which is 5% of the initial outlay, meaning that after the 5 years that you have used it, you are going to sell it for 5% of the $800,000 that you bought it for. So the scrap at the end of the year 5, which is also a positive figure, so which is equal to your 5%. It is in the ACCA Excel. You can do it. Multiplying shift plus 8, multiplying the 800, it will give you 40. That's 40,000. So it will be sold for 40,000. And the question says that the machine will not be replaced. The examiner has made it very simple because we have a replacement cycle and everything. EAC, I will touch on them in my next lectures. So production and sales from the new machine are expected to be 100,000 units. These are not in dollars, they are units that we sold. But in the investment in this work area, we are dealing with figures, we are dealing with money in dollars. So this is just units. So there's no way this 100,000 units can find its way here. So the examiner said that each unit can be sold for $16 per unit. So that's the revenue. So the 100,000 units can be sold for $16 per unit. So the revenue has nothing to do with year zero. We generate revenue after our investment, so which is year one. So the rate is $16. So the $16 multiplying the 100,000 units, which is 100, because we have three zeros up there. So 100,000 units. So we have our 1,600. So it will be same up to year 5. It will be same up to year 5. It will be same up to year 5 because the question said that the question didn't state anything about inflation. So we have also inflation. I've also touched on them. The question didn't say anything about inflation. So the 1,600 is constant for year 1 up to year 5, not up to year 6, up to the year end. The year end is 5 years, but I brought the 6 here because there might be an information that will require you to insert a figure in the year 6. You will get there. So for the useful life, it is 5 years. So the revenue is generated up to the year 5. And the question also said that there's variable cost. They will incur a variable cost of $11 per unit. So $11 per unit per the 100,000 units. So but it will become a negative figure because it is a cost. So the 11 multiplying the 100. 11 multiplying the 100. You just bring to a negative figure in front of the equal to sign. That's all. You drag it to the year 5. You drag it to year 5. That's all. So now you just subtract your revenue from your variable cost, which will give you contribution. It is in management accounting, it is in performance management. So your revenue minus your variable cost, but you can sum it because negative and positive is still negative. So when you sum the two, you are going to get the actual figure, which is 500. This is 500 because this is 1,600 minus 1,100, which is 500, and it is so for all of them. It is so for all of them. All of them are 500. And so when we continue from the question says that incremental fixed cost arising from operation of the machine will be $160,000 per year. Incremental fixed cost is 160,000. Here is fixed cost, so just 160. But in some cases, there are inflation, you have to adjust for inflation. I will touch on them in my next lectures. But this is a simple and basic NPV calculation. Are you getting me? Just a simple and basic NPV. So for you to get the whole idea about the net present value in about 30 minutes or so. So the first cost is 160. So you don't have to, you just have to drag it here to the year 5. That's all. It's Excel, so everything has become easy. So but the first cost is also a negative figure because it's a cost incurred. Food will not be food, it is a cost incurred. So all of them should become a negative figure because we have your, I think this one is management accounting, is self-explanatory. First cost is negative. So now taking your first cost from your contribution will now give you your taxable cash flow. But when you are doing management or account or performance management or management accounting, your contribution from your fixed cost will give you your profit. But here we are talking about investment appraisal, so your taxable cash flow will become 340. All of them become 340. But the question said that Wadun Co has an after-tax cost of capital of 11%, which it uses as a discount rate in investment appraisal. So do not touch it yet. It's a discount rate for the investment appraisal. And the question said that the company pays profit tax 1 year in arrears at an annual rate of 30%. You see what I was talking about? The question said that the company pays profit 1 year in arrears, meaning that the tax that the company pays is in arrears. They pay the tax a year after. So if they incur, so if there's a tax which they are supposed to pay in year 1, they pay it in year 2. The question is tailored in such a way that you have to think. There's no way they are going to pay tax in advance. They cannot pay a year 2 tax in year 1 because you haven't gotten to year 2. But so the question will either say that they pay tax in the year they incur, or in the year they make profit, or they pay tax a year after they make profit. So the reason why I was talking about this year 6 is because of the tax. So the tax in arrears, meaning that the profit we have, or the taxable cash flow we have in year 1 is going to be paid in year 2, and year 2's own is going to be paid in year 3, and year 3's own is going to be paid in year 4, so on. But if it was incurred in the year that the profit was made, year 1 is year 1, year 2 is year 2. And here it's simple. That's why the taxable cash flow is the same. So you know how to, you just apply the rate and just drag. But in some cases the figures are going to be different. So you have to take your time and apply the rate on each previous year's figure for the next year. So the annual rate of tax is 30%, and it is paid in arrears. So meaning that in year 1 you are not going to pay any tax, but the year 1's tax is going to be paid in year 2. So we have a zero figure here. So which is equal to the 30% multiplying the 340 in year 1. That's 340 in year 1, which is 102. Then you drag it to year 6. All of them should be 102. All of them should be 102. The reason why, let me go back so that you understand why the 30%. You see, I didn't put the rate on I didn't select this rate. I didn't select the year 2 figure. Multiplying, I didn't select the year 2 figure, but I selected the year 1 figure because that's the tax we are paying in year 2, not the year 2. So I selected the year 1 figure, which gave us 102. So when you drag, it will repeat the formula. So this figure, you see where the rate applied to the year 2 figure. When you go to year 4, the rate was applied to the year 3 figure. That's how it works. Very simple. But tax is also a negative figure. So you bring a negative sign. Then you drag. That's all. Then you just do your subtraction. So, but since the negative, you just have to add. So here you add. That's all. You drag. And I'm going to give you the after tax cash flow. That's all. So this is your contribution. So they are going to mark you for that. And this is your taxation. So these fixed costs are already in the question. The fixed cost is already in the question. The revenue and the variable cost, you have to look for them by applying the rate on the number of units that were sold. So you have your after tax cash flow. This is after tax cash flow, and that is what you are going to use to calculate for your net present value. So we have our working capital already, we have our scrap value already, so now we need our net cash flow. So our net cash flow is the sum of, here we have our initial outlay and our working capital. But here, you see here we added everything here because there's everything here zero, there are only two, so we added everything here. But here, your net cash flow, I'm not going to add everything from here. The only thing you are going to add is the after tax cash flow. This is the current cash flow that we have. So anything upwards has been taken for, and the resulting figure is the 340, 238, 238. Are you getting me? So the net cash flow is the sum of everything here, the working capital and the scrap. So when you drag it, it's going to repeat the formula up to year 6. That's it. So you see here it has added the working capital and the scrap. So that's our net cash flow. That's our net cash flow. That's our net cash flow. Now we have to look at our discount factor. And in the question, we have a cost of capital of 11%. Wadlin Co has an after-tax cost of capital of 11%, which it uses as a discount rate in investment appraisal. So the discount factor or the rate, let's say the rate, so the rate is 11%. So rate is 11%. That's the rate, 11%. The discount factor is in the tables. So you navigate and just go and copy and paste the discount factors, or you can also calculate for the discount factors. Then it is very simple. With the help of Microsoft Excel, you can use to calculate for the discount factors. So the discount rate is calculated as the one, that is, let's say 1 equals 1 plus the root. The root is 11%. Exponent, the number of years, but it should be negated, minus, that's exponent, negative the number of years, which is C4, that is year 1. Here the exponent figure is just shift and 6 here to give you that arrow, but here you press enter, it will give you the discount factor. But when you drag it, you see they are all 1 1 1 1 1 1, which is very wrong because it repeated the formula but not in the correct way. So equal to the your 1 plus your rate, which is 11%, to bracket exponent negative 1. But here we have to lock the 11 so that when it uses the exponent, it will use 2 3 4 5 6, but the percentage will be constant. Are you getting me? So if you want the percentage to be constant in the formula, you have to lock it, and by locking it, before the L you bring the dollar sign, which is the shift plus the 4, and after the L you bring the dollar sign. So we have logged the percentage. So now we can repeat the formula and it's going to give us the actual figure. That's it. Simple. But here the present value, the discount factor will be 1 because you are 0. Any figure exponent 0 is 1. So the discount factor will be just 1. So now the present values is now the we now multiply the net cash flows by the discount factors. So the 890 multiplying 1, you just drag them. I've gotten your present values. This is also your net present value